Yes, I'm live there and I'm also live over here. Good morning, everyone. Am I audible to all of you? Please type a yes in the chat box. Perfect. Good morning, my dear YouTube students. Am I audible to all of you? Please type a yes in the chat box and then we can start off with today's session. Good morning, Sri Ranjani. Good morning, Vivo. Artrika, it's clear, right? So, can I start off? Yes. Good morning, Naveen. Good morning, Sri Kumar. Good morning, Ekambaram. All clear, right? So, shall we begin off with today's session on intensive FM marathon? Already time is also very short. So, let's begin off now. Good morning, everyone. I'm very happy to see you all here today. Welcome to the Inter FM Intensive Marathon. Friends, the main objective of this Inter FM Marathon is that in one day we cover the most important questions for the upcoming examination. Once we cover the most important questions, by default you will have a higher probability of these questions coming in the exam. And if these questions come in the exam, automatically you will be able to score very good marks. Am I right? So here we'll not take too much of time on the concepts. We'll just quickly explain the concept and we will go and start solving the problems. Okay, everybody clear with this part? If you're all clear, please type a yes in the chat box. Yes, fantastic. So I hope everything is absolutely clear to all of you, right? Audio, video, everything is absolutely clear, right? Perfect. Yes. So let's start off, friends. Let's start off positively with today's session on the Inter FM Marathon. So friends, even before I start, many students are asking me what book should I refer for this. Friends, I am going to provide you free access to two of my books. The first book is what I call it as the ODBE book, or the full form of ODBE book is One Day Before the Exam. Okay. The second book to which I am going to give you access is what I call it as my mastery book. So mastery book is basically a detailed book in which, in this detailed book, you will have a lot of questions to be cracked, but I'm not sure you'll have time to do that now. So right now, which book are we going to focus on, friends? We are going to focus on the ODBE book. So I'll just quickly tell you now, we'll take 5 more minutes of your time so that you can get access to my ebooks. For doing that, I request you all to install my app. So how to install my app also I will tell you right away now. Please do it now itself. On the spot, I will give you access to the books. If you are a user of Android, just go to your Play Store and search for Tarun Jagdish. Alright, if you are a person who is using an iPhone, you please go to your App Store and there you will have to install an app called as Class Plus. Once you install the app, they will ask you for an ORG code. There you have to go and write ELEVM. I'll give you 5 minutes time, friends. Can you please do this now right away? Perfect. I can see students installing the app. Vikas Goda has installed. I'll just show you this page so that you don't lose out. I'll give you 5 minutes, friends. Everyone, please install the app now itself so that I can provide access to you. Are you all done, friends? Once you are done installing the app, please type done in the chat box, okay? Because only then I have to ask you to send me a request. Based on the request, I will give you access. Are you all done, friends? Once you are done it. Done, right? Okay. So once you have installed the app, then inside the app you will see two options below. One, home will be there. You will have batches and then you will have store. Click on batches. Batches. Everybody click on batches because it's coming in the batch. The book is available free of cost in the batch. Once you click on the batch, they will be asking you for a plus symbol below in the phone. Down you will have a plus sign. I think in blue color if I am not wrong. You have to click on the plus button. So when you click on the plus button, they will ask you to request for the batch. Are you asking you to request for the batch? Yes. Alright. So once they ask you to request for the batch, there you have to give a batch code, and the batch code is Inter FM 2025. Inter FM 2025. Inter FM 2025. That will be the batch code. The moment you send me a request, I will get the request over here, and based on the request I can accept and approve your access, and once you get the access, you will be able to get the book that we are going to use today in our class. Inter FM 2025. If you are facing any doubts, please send a hi or something in the chat box. Okay. Ekambaram, the batch code is Inter FM 2025. Aratrika, have you installed the phone? Have you installed the app? Once you install the app, after you install it, then down in the phone you will have options like there will be in the bottom side, home will be there, batches will be there, store will be there. Just check if you are able to see that now. Got it now? Yes, after you go to batches, you will see a plus symbol below. Bottom right, there is a plus symbol. There you have to go and give a request on Inter FM 2025. Yes, I have got 13 requests over here. Can I accept it now? Ananda, Ansif, Aparna, I am approving all of you, okay? Adirad, Aisha, Azhar, Basid, Ekambaram, Farhana, all those I have accepted. Anyone yet pending to be added, please let me know, because once you are added, only then I can tell you how you can access the book for today's class. Done, right? Anyone yet to do? If anyone is yet to do, I am waiting for 10 more seconds. Just send a message in the chat box. Not done. So I will wait for you. Okay, Akshata still doing. I'll wait for you. Let everyone upload it, friends. It will take maximum 5 more minutes. Then we are going to go in one full shot for today's session. Once I accept, those of you who have already accepted, you open the batch now. You will see that in the batches, you will see a batch called as Inter FM September 2025 free mentoring. Correct? The moment you click on that, on the top, you will have multiple options. Okay? In that option, if you scroll a little right, you will get a heading called as study material. Study material. The moment you click on that, you will come to this place. Study material will be there. Okay. Inside this, you will have two books, Mastery book, ODBE book. So we are now talking about which book, friends? We are talking about the ODBE book.
So can you tell the ORG code again?
ORG code is ELEVM. ELEVM.
That is a batch code.
Batch code is 1 minute. Inter FM 2025. Inter FM 2025. So then you go into this, you will get this book. I'm waiting for all of you friends. Let everyone finish. We will not rush. Let everyone complete. Only then I will go to the next part. Yes, Ananda. Inter FM 2025. Correct. So you will get a book like this in the study material. If you have got it, please confirm and type a yes in the chat box, friends. Aratrika, you got it? Excellent. Fantastic, fantastic. Let everyone get it, friends. Just 2 more minutes. Then we will start full swing without any more delay. We'll do as many questions as possible and I'll work with you so that we get maximum results for this class. Please mute yourself. I think somebody has unmuted. Now, did you get the batch? What is the options you see on the top? Endike options are കാണുന്നേ? Come again. Study material and no. Open the batch. Did you open the batch? ഒന്നുകൂടി refresh ചെയ്തിട്ട് open the batch. Open the batch now. Once you get inside the batch, അതിനുശേഷം after you enter inside the batch, then on the top you will have to scroll right to get the study material option. Yeah. The batch code is Inter FM 2025. Yes, without space. Batch code is Inter FM 2025 without space. All in small letter without space. Are you all clear now? Fine, friends. Wait, Akshata, you didn't get? Akshata, can you unmute and speak to me?
Yes, sir. I typed the batch code. Still didn't get it.
Did you enter the batch code as Inter FM? Okay, I think I have to approve your request in that case. 1 minute. I have to approve your request then. Maybe you sent a request a little later than I approved it. So I'll take it now. Don't worry. Yes, there are 9 more students who are pending in the request part. Yes, Akshata. Now check. Now you'll be able to see it.
Yeah, got it, sir. Thank you.
Thank you. Thank you so much. Now get inside the batch. Go to study material. All right. Yes, friends. So have you all got the e-book of the ODBE questions? Friends, hard copy if you need later on, tell me now. I think it's very short time for the exam, right? So next, yeah. I'm sorry, please repeat once again.
Sir, could you correct me again?
Okay, that's okay. Did you install the app? No, right? You did install the app, right? After installing the app, do you see a button called as batches over there? The moment you open the app, in the first page, you will see a heading called as batches. Are you able to see that?
No, sir.
No. What is the thing that you see in the main page, bottom side, the lowest part of the app? What do you see there? Batches. Click on that batches. Inside that you'll see a plus symbol now.
Yes, sir.
You click on the plus symbol.
Yes, sir.
Then they are asking you for a batch code, correct?
Yes, sir.
Enter the batch code Inter FM 2025.
Yes, sir.
Okay, the moment you send a request, I will get a request over here, then I can approve your request.
Yes, sir.
I think I've got it here. Pujita, right?
Yes, sir.
Done. I have accepted your request. Fantastic. So friends, I think we can start off now. Please type a yes in the chat box. Satish. Yeah. That's not possible. Everyone has got it. I'm not sure why. Can you just send? Did you send a request to Inter FM 2025 exactly without space?
Yes, sir.
You install the app from what, Android phone or iPhone? iPhone. Did you enter first Class Plus? You have to install the app called as Class Plus. Did you install that app? Did you enter the ORG code?
Yes.
ELEVM?
Yes.
So after you do that, you will come to a main page. In the main page bottom, what are the options that you see over there? Can you tell me? Click on batches. Now, when you click on batches, do you see any batches in front of you?
No.
On the top, do you see Inter FM free mentoring by any chance?
No.
No? Okay. Click on the plus.
It's given us.
Yes. Tap the plus icon. There you give Inter F. Got it? Okay. Yes, Satish. Once it's success, then you enter the batch. Yeah. Yeah, you have requested the code. I'll accept it now itself. Okay. Satish, once you have accepted the batch, then you have to again refresh. Just go to enter the batch. In the batch top, you just scroll right. You will see a heading called as study material. You have to click on the study material. There you will get the access to the ebook. I have accepted all the requests that has come to me so far. Yes, Sri Kumar, once you install the app, again you go to the main page and then click on batches again. Now when you click on batches, you will see a batch called as Inter FM September 2025 free mentoring. Enter that batch. Once you enter inside the batch, on the top, if you scroll right, you will see a heading called as study material. Okay. That study material, when you enter, you will get all the ebook will be available to you. Yes, Rikumar, is it clear now? Fine. I think friends, now we can start off with the class. I think anybody else who has not been able to get it, just WhatsApp me. I will arrange access for all of you. Okay? Yes, fantastic. So good morning everyone. Welcome to the Inter FM Intensive Marathon. I think we spent a little bit of a time to install the app and everything, but now you have some valuable resources available with you. These resources are sold, these books are sold for 1,000 rupees plus. So this is being given to you free of cost. This is very, very useful for your upcoming preparations. So now let us not waste any further time. Can we begin with today's session now? Please type a yes in the chat box. You sent a request, I'll accept it. Okay? Alright. I haven't got a request here. All the requests have been accepted. So you are already there in that case. What's your name? Yes. Shreya, you should be there already. Shreya V, you're there. Okay? Right. Just go to batches again. Take your app. Go to batches again. Okay, go to batches. In that batches on the top, you will see a lot of headings will be there. In that, if you scroll right, you'll get an option called as study material. Satish, I think, can you just go to the YouTube channel and check it there? I've given the whole thing. I think we have spent almost 20 minutes on that. So that access will be arranged for you, Satish. Okay, just check the YouTube channel. The recordings are available there. Okay, clear now? Shall I begin? Okay. So friends, how I'll take my class also I'll explain to you. We will break up the class into two parts. Part number 1 will be concepts. Part number 2 will be problems. Okay. So first I will tell you a quick explanation about the concept. We'll not spend too much of time on the concept. In my regular classes I give a detailed logic explanation. Here we'll just go quick on the conceptual part. After that, what we will do, we will start to solve a lot of problems together. Everybody clear with this part? So concepts, problems like that. Every problem when I solve, I will solve it in a very, very logical manner, explaining you the logic of this entire thing. Okay. So keeping this, let us begin with today's session, friends. I'll start with first concept. We'll start with the basics. So friends, in the basics, the first and the foremost concept that you would have learned is NPV. What is the full form of NPV? Everyone tell me. It is net present value. Okay. Then here, what is the table format for calculating NPV, friends? Here, cash flow, discount factor, discounted cash flow. So let me say if I am putting year 1, 2, 3, you have in year 0, you have invested 100, year 1 you get 200, year 3 you get 300, year 2 you get 300, year 3 you get 400. And if your discounting factor is 10%, we find out the NPV. How do we work it out? 1.909, 0.826, 0.752. So here I'll get the number as minus 100. Here I'll get the number as 200 into 0.909 will be 181.8. Other one will be 300 into 0.826, that will be 247.8. Okay. Then 400 into 0.752 will be 300.8. So then when I take the total, I'll get the number as 181.8 plus 247.8 plus 300.8 minus 100. So I'll get the NPV as plus 630. NPV is positive or negative, friends? NPV is positive. If NPV is positive, should I accept the project or reject the project? I should accept the project. Are you clear with this part? So what is the formula for NPV? Everyone tell me. The formula for NPV is present value of inflow minus present value of outflow. Everyone repeat the formula with me. Present value of inflow minus present value of outflow. All right, friends, are you all clear with this part now? Yes. Can I go to the next one? Okay. So once you're clear with the basics part, let me go to the next one. Friends, in this basics, we have to understand there are two terminologies. First one is called as cash flow and the second one is called as discount factor. Cash flows are not similar to profit. What they do is from the profit, from the PAT, we add back depreciation. Okay. So we get the cash profit. That is also not enough. From this, we reduce whatever is my capex or what is my additional capital investment that I do. That's a cash outflow. Minus, we again reduce the additional working capital. So once we do this, we get our free cash flow. Okay. So once again, I tell you, how do you derive at cash flow? You take the PAT, you add back the depreciation, then you reduce the capex and you reduce the additional working capital. Discount factor in simple terms means investors' expectation. So what is the return that the investor is expecting? How does an investor expect also I will tell you. Now suppose Tarun is an investor. I will have two options. One option that I have with me is I can invest the money in my father's business. The second option that I have is I can put the money in whatever business I am starting. If I put in my father's business, I am getting 12% returns. If I put in any other business, I don't know how much returns I will get. So what I will do is, at least the minimum return which I should get shall be how much percentage, friends? 12 percentage. So in simple terms, this 12 percentage is my opportunity cost. Okay, can you quickly write down this in your books now? Fine, friends. I hope everything is comfortable. Please type a yes in the chat box if everything is comfortable, friends. All right. Shall I go to the next part now? Okay. Now I'll teach you a very, very important concept which is applicable to almost all the chapters in the Inter FM. But it is not taught as a concept, due to which many of the students don't get a grip on this. It is called as how to value an asset. Friends, this is one very, 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 very important concept. How to value any asset. Friends, value of any asset, whatever you talk about a share, you talk about a bond, you talk about a debenture, you talk about a preference share, you talk about a company. Value of any asset is the present value of future cash flows which the asset can generate. So basically, friends, I can give you some examples. Zomato recently had a valuation of $9 billion. How did that value arrive? It is nothing but the present value of whatever is the future cash flow that Zomato can generate. Forget about Zomato. We'll talk about some other thing. Now, for example, Hrithik Roshan. You all watch movies? Yeah. Hrithik Roshan. How much money does Hrithik Roshan charge for a movie? If you tell me that Hrithik Roshan charges around 10 crore per movie, why do they pay him 10 crore per movie? Is because if Hrithik Roshan acts in a movie, if that movie works or does not work, still that movie will be able to generate at least 10 crore plus revenue. Considering that, Hrithik's automatically valuation will become 10 crore. Now suppose Hrithik is coming up with endless flop movies. Flop number 1, flop number 2, flop number 3. After that, do you think Hrithik Roshan can demand the same 10 crore? No. Why? Because now the future revenue that can be generated by Hrithik comes down. If that comes down, automatically the valuation will also come down, friends. Are you all clear with this part now? Yes, so value of an asset is nothing but it is the present value of future cash flows. Quickly write down this in your books, friends.
Sir, can you show the previous page of minutes?
Yeah, sure. I'll share these handwritten notes with all of you, okay? You don't have to copy down everything as such, but scribble down in the class so that you don't lose out on the concentration part. Since it's a one-day marathon, I might go a little faster, but all the notes, handwritten notes will be shared with you. In the end of the class, a PDF will be shared with all of you in the WhatsApp group, okay? All right. Thank you. Thank you so much. So are you all done writing till here in your books now? Okay. Now I will write down the next very, very important heading. How to value a share. So earlier I taught you how to value an asset. Everyone tell me, how do you value an asset? Value of an asset is nothing but present value of future cash flows. Correct. So same way, value of a share will also be what? It will be the present value of future cash flows which the share can generate. Everybody clear with this part now? Which the share can generate. So now what are the future cash flows the share can generate? Share mainly has dividends. And some of you might think redemption value. Friends, a company has unlimited life, correct? So what happens is there is no redemption value from company point of view. There is redemption value only from whose point of view? Shareholder point of view. So for example, if I am holding a share, if I am selling it, yes, I can sell. But company point of view, they are not buying it back, correct? So ideally what happens is the price of a share is set to be present value of dividends forever. Now when I say forever means towards infinity. It means towards infinity, or it is also what we call it as perpetuity. So now we need to understand what is the meaning of perpetuity and how do we find out the present value of perpetuity. Everybody clear? Can you please write down till here in your books first? Alright friends, are you all clear so far? So now I will give a heading over here called as present value of perpetuity. Present value of perpetuity. Friends, the formula for present value of perpetuity is cash flow divided by discount factor minus growth. So I'll give you a simple example, friends, and this example is something what you can correlate. Friends, why are you doing CA? Why do you want to pass this exam? So that you can work, correct? Why do you want to work? So that you can make money. Ultimately, what is your objective? Making money. Friends, I being a finance faculty, I would like to teach you one small thing about financial independence. You should not work in a way that you keep on working throughout your life. Your objective should be you should be able to happily retire by the time you are 50 years old. So if that has to happen, I'll give you a simple example or a numerics that you can work it out. If you can somehow invest, let's say some particular money, okay, or maybe I'll put it in a different way, okay. I'll put the sentence in a different way. By the age of 50, I want to earn, let us say, 20 lakhs per year with, let us say, a 5% inflation. Okay, forever. How much should I invest now? Or by the age of 50 might be confusing. Just I'll put it this way. I want to earn 20 lakhs plus 5% inflation forever. How much should I invest now? So basically, friends, mutual funds is a very, very good place where you can invest money. So if I invest some particular money, okay, I should be able to generate 20 lakhs every year plus 5% inflation. Okay, so friends, if you put in mutual funds, I'll just put over here, mutual funds give 12% return. And this is a market reality. Okay, normally if you invest in a proper mutual fund, they give you 12% return. So friends, I can apply this formula now. So if I apply this formula, 20 lakh is the cash flow divided by my expectation is 12% minus my growth is how much? 5%. So now tell me what is 20 lakh divided by 12% minus 5%? Do you get the answer as 285 lakhs? Or friends, the meaning of 285 lakh is that if by the age of 50, somehow you are able to arrange 2.85 crore, that's absolutely possible as a CA because you'll be getting very good salary. It can start with 1 lakh per month, then it can go up to 2 lakhs, 3 lakhs, 4 lakhs, it can go up, correct? But you have to save in a way that somehow you should invest 2.85 crore in a mutual fund. Once you do that, every year the mutual fund will give you a return of 12% and you can withdraw that money and you can live forever because it will keep on coming towards perpetuity. You can try this in Excel. Put 285. If you do 285 into 12%, you will get 34 lakhs. Don't withdraw the whole 34 lakhs. Withdraw only how much? 20 lakhs minus 20. Still you will have 14 lakhs extra with you. That 14 lakhs extra will get added to the 285 lakhs. So total becomes 299 lakhs. This 299 lakhs, on this again you will get a 12% return. Like that, you work it out in Excel, friends. You can live happily forever without working anymore. That is the power of perpetuity. And what is the formula for perpetuity, friends? Cash flow divided by discount factor minus growth. Can you quickly write down this formula in your books, friends? Also, friends, please scribble along with me so that we can cover more questions. All right. I just want to get the base clear. After that, I want to go into the problematic part. Is everything comfortable so far, friends? Please type a yes in the chat box. Perfect. All right, friends. Are you all clear so far? Yes. Once you are clear with this, I will again come back over here. Okay. So when I come back over here, I want to find the value of a share. Now tell me, what is the value of a share? Present value of dividends forever. We learned the formula cash flow divided by discount factor minus growth. Am I right? Same way, what will be the formula for perpetuity? It will turn out to be D1 divided by discount factor for equity shareholders is called as KE minus G. Okay, can you quickly write down this? So what is the formula for Gordon's model? This model is what we call it as the Gordon's model. P0 is equal to D1 divided by KE minus G. Satish, which figures are you talking about? You mean this 285 lakhs? Okay, you want me to explain to you how this 285 came? I'll just write down and show you. Now you have 285. On this, you will get 12% return. So you will get 34.2 in your hands, correct? But you want only 20 lakhs in the first year. So 285 plus 34.2 minus 20, when you do, your closing balance will become 299. Next year's opening balance is 299. On this again, you will get 12%. So you will get around 36 lakhs over here. Next year, you will need 20 lakhs plus 5% inflation. So you will not need 20, you will need 21 lakhs, correct? But still, if you check 299 plus 36 minus 21, when you do, you get 314 lakhs over here. So do you observe one thing? Even though you are withdrawing 20 lakhs, 21 lakhs, etc., your balance from 285 lakh is becoming 299, then it is becoming 314, and then it is going on further. Are you all clear with this part? So you can earn 20 lakh plus 5% inflation forever. Are you all clear with this part now, friends? Can I go to the next one? Okay. So I believe you're all done with this part. I will now go to the next part. All right. Yes, let me go to the next part. So I think, friends, now we will learn about in case of company for shares, there are 3 models that you have to learn, or there are 2 theories that we have to learn. I'll put it that way itself for you. The first theory is called as dividend relevance theory, and the second theory is what we call it as dividend irrelevance theory. Okay, dividend relevance theory, dividend irrelevance theory. Dividend relevance theory says that if a company pays dividend, it is absolutely relevant for all of you. So here there are two models. First model we learned, which is called as the Gordon's model. Second model is called as the Walters model. Dividend irrelevance theory fellow says that whether you give dividend or you don't give dividend, it is not relevant at all, and this is where one great fellow comes into picture. His name is Modigliani Miller. This fellow makes our life miserable at the interlevel. Okay, so these are the three theories, friends. What is the first one? Dividend relevance theory, and the other one is what? Dividend irrelevance theory. So I think we already learned about relevance theory, Gordon's model. So here we learned about Gordon's model. What is the formula for Gordon's model? P0 is equal to D1 divided by KE minus G. Second model is called as the Walters model. D by KE plus E minus D into R by KE whole divided by KE. Friends, logic I'll just quickly explain. I don't have time to explain in detail, but in simple terms I'll tell you. Here it was D1 by KE, correct? Here it is what? It is only D divided by KE. So when you talk about D divided by KE, this is nothing but this is present value of dividend. Plus E means earnings, D means dividends. So E minus D will be what? It is the earnings minus dividend, or that is my retained earnings. Everybody clear? Into R is the return that I get. So when I reinvest my retained earnings, what present value I get? So the second part is present value of retained earnings reinvested. Okay, that's how we get the total present value price of the entire thing. Everybody clear with this part? So in Gordon's model, it is D1 divided by KE minus G. In Walters model, it is D by KE plus E minus D into R by KE whole divided by KE. Can you quickly write down this in your books now, friends? Yes. Friends, I hope the space is comfortable for all of you. Yeah? All right.
Yes. Yes.
All right. So I think you're all done. Yeah. Can I believe you're done with this also. Okay.
Yes, sir.
Done. Fine. Now I'll quickly go to Gordon's model. We'll just do some investigation. When you enter into Gordon's model, the formula we have learned, P0 is equal to D1 divided by KE minus G. So here, first we need to find out what is D1. Second, we need to find out what is KE. Third, we need to find out what is G. These are the three things that we need to do. D1, exam point of view, this is a very, very confusing thing. But ideally, the formula for D1 is D0 into 1 plus G. So whatever is your last paid dividend, along with the growth of 10% or whatever be the growth, will give you the D1. KE means equity holders expectation. KE means equity holders expectation. This is found out actually using CAPM. What is the formula for CAPM? RF plus beta into RM minus RF. Growth has a formula that is G is equal to BR, or it means retention ratio into rate of return, or that is nothing but your ROE. So these are the three sub formulas which comes in for the Gordon's model: D1, KE and G. Can you quickly write down this in your books now? Okay friends, so I believe you're all done with this part. Now friends, in the exam, whether the dividend given is D1 or D0 is a big mess. Okay. Normally, if the words are expected dividend, then what will it be? Will it be D1 or D0? Come on, tell me. If the word is expected dividend, is it D1 or D0? Chat and tell me. Expected dividend, is it D1 or D0? Friends, expected dividend is D1. Everybody clear with this part? What about last paid dividend? Last paid dividend is what? D1 or D0? Last paid dividend is D0. Now the confusion comes when they use some word other than these two words. Like sometimes they will use the word current dividend. Friends, if they use the word current dividend, then it is a total headache. You can either assume it to be D1 or D0. Give a note in the exam. It is assumed that current dividend is D1, or it is assumed that current dividend is D0. Everybody clear with this part now? Okay. So I think we are clear with the concept of Gordon's model also now, friends. After that, we have to learn about Modigliani-Miller. This fellow is a dangerous fellow. Modigliani-Miller, this fellow came up with a beautiful formula. The formula that he told is NP0 is equal to P1 into N plus M plus E minus I whole divided by 1 plus KE. I'll tell you the logic of this formula quickly, friends. P0 is price today. N means number of shares today. So N means number of shares today. P0 means it is the MPS today. P1 is going to be the MPS in the next year. E is your earnings. I is your investments. And 1 plus KE, when you divide, when you do 1 divided by 1 plus KE, you are taking the present value of whatever it is. Basically, you are taking the present value. That is why you do 1 divided by 1 plus KE. Okay. So with this, I'll just interpret this formula, friends. Can I say P0 into N is the number of shares today into market price today? Number of shares today into market price today, will it not give you the market value today? Market value today is equal to P1 is the market price after 1 year, correct? Into N is the existing shares, M is the new number of shares. So when I take N plus M together, do I get the total number of shares after this thing, correct? So number of shares afterwards into P1 will give me my market value after 1 year. Plus earnings after 1 year minus investments after 1 year, whole divided by 1 plus KE. Friends, Earnings is nothing but PAT plus depreciation. Profit after tax plus depreciation is what we call it as earnings. Investments is nothing but capex and additional working capital, because you invest either in capex. So friends, now tell me, this together is actually nothing but it is PAT plus depreciation minus capex minus additional working capital. That is what? Cash flow. Even market value after 1 year is also cash flow. So can I say market value today is equal to future cash flow divided by 1 plus KE? What is 1 plus KE? Present value. Or what are they again telling over here? They are saying that market value today is present value of future cash flows. Again we come back to the same point, friends. Can you please write down till here in your books now? Yes, friends. Are you all done writing till here in your books now? All right. So once you are done writing till here, now friends, what we will do is, now we will go to the next part, and I'll tell you there are 3 steps in calculating Modigliani-Miller. Step number 1 is called as calculate P1. P1 is found out using the formula P0 into 1 plus KE minus D. So price today is, let us say, 100 rupees. My expectation is 10%. So next year I should get how much money, friends? Next year I should get 110. Am I right? Okay. So once I get that, one minute, friends, 1 minute. Okay. So I get 110. From this, let us say I'm paying a dividend of 5. So what is 110 minus 5? Do you get the answer as 105 over there, friends? Correct? So that is how you calculate P1. After you calculate P1, step number 2, we have to calculate M. M means what? What is the new number of shares? So how do you work out the new number of shares? Point number A, first we go and we find out what is the fund shortage. How we know that is, we know what is the investment, that is an outflow. We know how much dividend we have to pay, this is also an outflow. Point number C, less we will know how much earnings we have in our hands. This earnings is going to be our inflow. So investments plus dividend minus earnings, when you do, what do you get in your hands? Do you get your net cash flow over here, friends? Am I right? once you get your net cash flow shortage, this cash flow shortage is what we are going to raise new shares. So that will be raised at P1. So then what we do, this is called as I. This one is called as I. This one is called as D. This one is called as E. So can I say the net cash flow shortage is I plus D minus E? And then P1. So what is the formula for M that you learn over here? I plus D minus E whole divided by P1. Can you quickly write down this in your books, friends? Then we are going to start cracking problems. After this, step number 3 will be solving the equation. Solve the equation. Okay, come on. Can you write down this quickly? So we are done with the conceptual part. Can we start solving questions one by one now? Perfect, friends. Are you all done writing? Just quickly write down this also. Fine, friends. So I think you're clear with this. Now let us go to our ODBE book. Okay. So everyone please take your ODBE book. We'll start with the first question, which is a very good question on Modigliani Miller. Everybody ready? Shall we begin with that now? Okay. Friends, when you start solving a question, so I'll write down question number 1. Any question you start solving, our challenge over here is to understand the question. So what I'm going to do is I'll start this with working note number 1, basic data. Alright. So in here we'll write down all the numbers that are given in the question. Friends, even before I continue, I just forgot. You can note down my number. If you are facing any doubts, you can always WhatsApp me here. Or if you just send me a hi, I will save your number. So tomorrow if you have any queries or any doubts, you can always WhatsApp me. And I have a website. If you need to, take any classes or you want to get some free lectures, it's available over here, tarunjagdish.com. Okay. So if I save your number, then if you have any doubts in the future, you message me, I'll be able to respond back to you. All right. Yes. Working note number 1, basic data. Rambo has 1 lakh equity shares. So I'll write down over here, number of equity shares, that is equal to 1 lakh shares. One lakh shares. For the year 2022, the current market price of the share is 100. ₹100 per share. Company is planning to pay a dividend of 10 rupee per share. So D is equal to 10 rupee per share. Required rate of return is 15%. So KE is turning out to be how much percentage, friends? 15%. Alright, next. 15%. Based on Modigliani Miller approach, calculate the market price of the share of the company when the recommended dividend is declared and not declared. So there are 2 scenarios. One dividend declared, other one dividend is not declared. How many new shares are to be issued by the company at the end of the year, assuming that the net income for the year is 40 lakhs? Net income is 40 lakhs. Investment budget is 50 lakhs. So capex or I is how much? 50 lakhs. Can you quickly write down the basic data in your books, friends? Because once you write down the basic data, you understand the question, then solving becomes very, very easy. Alright friends, are you all done writing till here in your books now? Okay, I'll go to the next part now. Working note number 2. Now we have to solve it. So there are two scenarios I told you. First scenario, what are we going to take? We will take it as dividend declared. Okay. Wait, Artrika, your doubt is when I solve, I do represent the data but not in a separate working note. No. You can do it however you want, but write down the numbers, because once you write it down, you understand the question better. Like that, you get very good marks. That's the only objective over here. Okay. So now what are we talking about? Dividend being declared. Correct. So when you are trying to declare dividend, I'll go through the 3 steps. What are the 3 steps? Everyone tell me. Step number 1 is what? You have to calculate your P1. So what is the formula for P1? P0 into 1 plus KE minus D. Am I right? Minus D. Am I right? So when you do this, how much is the P0 in our example? Is it turning out to be 100 rupees per share? Into 1 plus, what is the expectation over here? 15%. Minus, what is D over here? 10. So do you get the answer as 105? That is your P1. Step number 2, we have to go and calculate what? We have to calculate M. So the formula for M is I plus D minus E. So how much is the investment that you have over here? I investment is how much? 50 lakhs. Plus dividend. What is the dividend that they have told over here? 10 rupee per share into 1 lakh shares. So what is 10 rupees per share into 1 lakh share is equal to 10 lakh. That is also an outflow. Minus what is my earnings that's told over here? 40 lakhs. So 50 plus 10, 60. 60 minus 40 will give you 20 lakhs. 20 lakhs divided by 105 is the price per share. Do you get the answer as 19,047.61 shares? Okay. So we got P1 and we got M. Can you quickly write down this in your books now? All right, friends. Are you all done writing till here in your books now? Okay. So once you are done with this, then I will write down step number 3. solving the equation. So NP0, so how do you do NP0? NP0 is equal to number of shares. What is the number of shares that is available over here? 1 lakh shares are there, correct? 1 lakh shares into what is P0 that you have over here? 100. So do I get the answer as 100 lakhs over here? What is the second part coming over here? P1 into N plus M minus, plus E minus I, correct? Whole divided by 1 plus K. So here my P1 is going to be how much, friends? We got the P1 as 105 into N plus M. What is the number of shares that we have over here? Already we have around 1 lakh shares plus 19,047. So 1,19,047.61 shares into P1. Okay, I think that's what we have done. Plus earnings. What is the earnings that we have over here? Is the earnings coming to be 40 lakhs? Minus investment. What is the investment that you have over here? 50 lakhs. Correct? Okay. Hold on. Okay, P1 into N plus N plus E minus I whole divided by 1.15. So now tell me what is 105 into 1,19,047.61 plus 40 lakhs minus 50 lakhs divided by 1.15. So do I again get the answer as 100 lakhs, friends? Hence proven that my LHS is equal to my RHS. Can you please write down this in your books now? Alright friends, are you all done till here now? Okay, so now we are done with situation number 1. Now let me write down situation number 2. In this what we'll do, we'll take dividend not declared. Okay. So when you do dividend not declared, step number 1, I'll find out P1. What is the formula for P1? Can you tell me? P1 is equal to P0 into 1 plus KE minus D. So that is equal to 100 into 1 plus 10% minus, now dividend not declared, I'll keep it as 0. So do I get the amount as 110 itself? Step number 2 is what? M. What is M? How do you find out M? Investments. So how much is the investments that you have? 50 lakh plus 10 lakhs minus 40 lakhs minus 40 lakh divided by what? Divided by 105. No, it will be divided by 110 now.
Sir, isn't K 15%?
Oh yes, thank you for letting me know. K is 15%. So I'll get the number over here as 115. So sorry, I had a wrong number in my mind. So it will be again divided by 115. Correct. So now it will be 50 lakh plus 40, plus 10 lakh, 60 minus 40 divided by 115. That will give me the answer as 17,391. Please confirm. Am I right? Yes, 17,391. Step number 3, what we are doing over here is we'll find out NP0, that is equal to 100 lakhs. Step number 4 will be P1. P1 is going to be how much now? 115 into 1,17,391 plus earnings minus your investment is 50 lakh whole divided by 1.15. 135 lakh plus 40 minus 50 divided by, wait, I have done some mistake somewhere, friends. Can you please help me out where I have gone wrong? I is the investment, right? Have I taken the investment part correctly? 50 lakh plus, okay, hold on, here dividend is not there. So sorry, this will be 0. Dividend not declared, correct? Dividend is not declared. So this part will be 0. Plus 0 minus 40 will be 10 lakhs divided by 150. 8,695 shares. So here also it will be 8,695 shares. Sorry, it will be 1,08,695 shares.
Previous page, 1 minute.
Yes, 1 minute. You get the answer as 100 lakhs. Hence proven that whichever way you move, you will get the answer as 100 lakhs only. You want the previous page? Yes, please write down in the previous page. All right, friends, are you all done writing till here in your books now? Is everybody clear? Is everything comfortable so far, friends? So we have done one question now. I hope you're all comfortable and the classes are going fine for all of you. Like this, correctly, we'll start cracking questions one by one. All right. Perfect, friends. Perfect. Fine. Thank you so much. Let's go to the next question now. So we are done with question number 1. Let's go to question number 2 now. Wait, question number 2. I'll just do the difficult ones, friends. The easy ones we can keep it outside. 2 is okay, manageable. Friends, questions and answers are given. Some questions you can do it yourself. I want to work out some tricky problems. This is a very good question. Question number 3. It is a question on two-stage dividend discount model. Okay. So I'll write down. I'll take question number 3. Working note number 1. Basic data. So here X Limited is a multinational company. Current market price per share is 2185. So I'll write down MPS is equal to 2185. Point number B, they have told the company has paid 140 rupees, paid 140 rupees as dividends. So what is the D1 or D0? It is D0. Hold on, friends. D0. After that, they have told company is expected to grow at 12% per annum. Grow at 12% per annum. Let's go to the next part. Okay. For the next 4 years. So it's going to grow at 12% per annum for the next 4 years. Okay. And 5% per annum for an indefinite period. So for an indefinite period. Expected rate of return of shareholders is 18%. So what is the KE that you have over here? 18%. Please write down the basic data in your books, friends. All right, friends, so I'll just draw a diagram to explain this to you. So here what is happening is, D0 2185. Okay, then D1 is going, sorry, D0 is 140. We'll put D1, D2, D3, D4. Okay. So what happens is it's growing for 4 years at 12%, right? So 140 plus 12% will be how much? It will become 156.8. Then it will become 175.61. 196.69. 220.3. Okay, after that when you go to D5, from here you will be taking plus how much percentage is going to be your perpetual growth rate from here? It is going to be 5% forever. Friends, keeping this, they want you to find out the value of a share. How do you find out the value of a share? How much is the KE? KE is turning out to be how much? 18%, right? Friends, we have learned that value of a share is nothing but present value of future cash flows. Yes or no? So I'll give you 2 minutes time. Can you try doing this yourself? Here the speciality is that you got two types of cash flows. First you have a high growth cash flow, then you have a perpetual cash flow. Okay, can you please write down this and get back to me? Try doing it yourself. Yes, friends, now tell me, are you by any chance able to do this and are you getting the answer for this question? Shall we do it together now? Okay, let's do it together. So friends, how we will work out this question is that we will take first part here, cash flow, discount factor, discounted cash flow. So now tell me what are the cash flows you have. 156.8. Year 1 is 156.8. Year 2 it will be 175.61. Year 3 it is going to be 196.69. Year 4 it is going to be 220.30. And then from year 5 onwards, price 4 is equal to D5 divided by KE minus G. So D1 gives you P0. So D5 will give you what? P4. So P4 will be equal to, what is D5 that we got over here? 220.3 plus 5%. Do you get the answer as 231.315 divided by, what is the KE that you have? 18% minus 5%, correct? So when you do this, do I get the answer as 1780 approximately? This number will come over here as the 4th year price. Okay, and we have a discounting factor of 18%. Then whatever number you get over here will be your price using what model, friends? Two-stage dividend discount model. Can you write down this and tell me what answer you get over here? I believe you're all still writing. Once you're done, tell me the answer. Okay, I'm waiting for your answer. Then only I'll proceed to the next question. I hope all of you are comfortable, friends. If yes, please type a yes in the chat box also. Perfect. Please do let me know the answer also. I'm waiting for you to tell me the answer. Then we will go to the next question. Come on, friends. I'm waiting for the answer. I believe you're all doing it right. I'm waiting. I'll wait for you. Yes, is that 1408? I believe that's the answer. 1408. Yes, you should take the PV factor also. I think you've done that, right? I mean, you would have taken 18% and then whatever answer you get, that answer is how much, friends? 1408, is it? Okay. 1408, 1409. Yes, friends. I think I'll give you one more minute. Many of you are still working out. Let everyone finish. Then we will go to the next part. Fantastic. So friends, we are done with this question also. This was a beautiful question on two-stage dividend discount model. Everybody clear with this part? Okay. Now let me go to the next. Let me go down and check. Yes, 1780 is what they got P for. 1408. Is that what we got? Yes. The answer is correct. Okay, now I think we'll do one quick question on both Gordon's model and Walter's model. This question is easy, but this is a past examination question also. Shall we quickly do this now? Question number 4. Working note number 1. Basic data. So earnings is turning out to be 30 rupees per share. E is equal to 30 rupees per share. D is equal to 9 rupees per share, and then cost of capital KE is equal to how much percentage? 15%. One moment. 15%, and R is equal to 20%. So friends, first I'll find out using Walter's model. So what is the price that you will get under Walter's model? D divided by KE plus E minus D is equal to 21. 21 into 20% divided by 15% whole divided by 15%. Do you get the number as 60 over here? Plus 186.66. So do you get the answer as 246.66 over here? That is the answer you get under what model? Walter's model. Now I'll do it under Gordon's model. Now when you do under Gordon's model, friends, ideally 9 is actually your D0, because that's what you take over here. But I'm not sure, in many cases your textbooks do it wrongly. Actually, if you take 9 over here in Walter, that is D0 that you take. Understood? So that should also be D0 over here. So we need to find out D1. How do you find out D1? D0 into 1 plus G. How do you find out G? G is equal to BR. So B is the retention ratio. So for knowing the retention ratio, first I need to know the payout ratio. So that will be 1 minus the payout ratio. Payout ratio is 9 divided by 30. 30%. So that will be 70%. Okay. R we know. So G will be equal to 20% into 70%. So do you get the answer over here as 14%? G is equal to BR. Then you have D0. Okay. D1 will be equal to D0, 9 into 1 plus 14%. Do you get the answer as 10.26? Correct. Now when you find P0, what is the formula? D1 divided by KE, that is 15%, minus G. You'll get the answer as 1026. This should be the answer, friends. Okay. Let's check how your ICI material and the suggested answers have come. 1 minute. Okay. D1 1026. Is that the number? Yes, we got the same answer as per Walter, 246.66. The answer is correct, friends. Can you write down this and finish it off now? Are you all done writing till here in your books now, friends? So we are done with Walter's model and Gordon's model also. We did Modigliani Miller. We have also done a question on this thing. We have also done a question on two-state dividend discount model. That is the main three things that comes from dividend policy decision. Now, can we quickly go to the next chapter of financial leverage? So I'll just quickly give you the brief of this chapter, leverages, friends. Leverage, I'll give you a simple example and tell you the logic of leverages. All right. Now let us say the company has a sales of 100 lakhs. Or maybe I'll just put it this way. This one concept will explain the entire logic of leverages. Particulars 2024, 2025. Sales, suppose it is 100 here and it is turning out to be 110 over here. Okay. Your cost of goods sold over here is 50, here it is 55. So your contribution over here is 50, here it is 55. Fixed cost is 20, here also 20. So your EBIT will turn out to be 30 and here it will be 35. Interest is, let us say, 10, here also 10. So what will be your EBT? EBT will be 20 over here, 25 over here. On this you will have a tax of 30%. So let us say 6, 25 into 30% will be 7.5. So once you reduce this, you will get your earnings after tax, that is 14 over here and 17.5 over here. Okay. So these are the numbers, for example. Okay. Now we have to find out three things over here. One is financial leverage. So I'll first put percentage change also. So here I think you have a percentage change is turning out to be around 10 percentage. Correct? What about 55 divided by 50? That is also 10 percentage increase. Correct? When you come down, what about your EBIT? 35 divided by 30 will be plus 16.67 percentage. What about EBT? 25 divided by 20. That is turning out to be 25 percentage, I think. Correct? Yes. 25 percentage, and 17.5 divided by 14 will also be plus 25 percentage. So did you observe one thing? Whatever is the percentage change in EBT and the percentage change in EAT will remain the same. Whatever is your percentage change in sales and percentage change in contribution also will remain the same, friends. Can you just write down this example in your books? Because only with this example I can explain to you. Alright friends, are you all done writing till here in your books now? So friends, from this we need to find out three types of leverages. First one is what we call it as operating leverage. So operating leverage we can find out using two particular methods. The first method is contribution divided by EBIT. Contribution divided by EBIT. So your contribution is 50, EBIT is 30. So what is 50 divided by 30? Can you tell me? 1.66. So the logic, what is the logic of this 1.66 is that for every 1 rupee of EBIT, I have 1.66 rupees of contribution. Or you can find out in the opposite way. You can just change it as percentage change in EBIT divided by percentage change in contribution. Shall we check that now? What was the percentage change in EBIT? 16 and 10. So it will be 16.67 percentage divided by 10 percentage. So what is the answer you get? Do you again get the answer as 1.66, friends? So either you use contribution by EBIT or you use percentage change in EBIT by percentage change in contribution. Your answer will remain the same. Can you write down this in your books now? Alright friends, I believe you're all done with operating leverage. Exactly in the same way, what can we find out now? We can now find out the financial leverage also. Financial leverage. Again, here you'll have two formulas. First formula is going to be EBIT divided by EBT, or what will be the second formula, friends? Percentage change in EBT. It can be EBT, or it can be EAT, or it can be EPS, because all these three has got the same percentage change divided by percentage change in EBIT. So what is the EBIT that you have over here? EBIT is 30 divided by EBT is 20. So what is 30 divided by 20? Do you get the answer as 1.5? Okay, what about the other one? 25 divided by 16.67. You will again get the answer as 1.5. So friends, whichever formula you use, your answer will remain the same. Quickly write down this. Fine friends, I believe all of you are done writing this also in your books. Can I go to the next part now? Okay. Yes. Last part is going to be combined leverage. Combined leverage can be found out using three methods, friends. First method can be contribution directly divided by EBT. So when you do contribution divided by EBT, that is 50 divided by 20. So what is 50 divided by 20? Can you tell me? Do you get the answer as 2.5? That's the first method. Alright. Second method that you can use is you can do degree of operating leverage into degree of financial leverage. So it will be 1.66 into 1.5. Do you again get the answer as 2.5? Or what is the last method? Percentage change in either EBT or IAT or EPS divided by percentage change in either contribution or it can be sales, any one of this, because both will have the same percentage change. So now tell me, that will be percentage change in EBT is how much? 25%, other one is 10%. So it will be 25% divided by 10%, 2.5. All the three will give you the same answer. Can you write down this in your books now? All right, friends. Are you all done writing this? Can we quickly do a question and then take a break? Okay, so after the break, we can do the other chapters now. So let's do question number 5 now. Question number 5, the working note number 1, basic data. All right. The capital structure of ABC Limited for the year ended 31st March consisted of the following: equity share capital, then you have debentures also with a face value of 100 and 10% debentures of 100 rupees each. Alright, so that's 2020. During the year, sales decreased to 1 lakh units as compared to 1 lakh 20,000 units in the previous year. So I'll do one thing. Particulars, previous year, or wait, I'll just write down over here. Current year, previous year. Alright, sales decreased to 1 lakh units compared to the previous year 1 lakh 20,000. So current year it is how much? 1 lakh. Previous year it is 1 lakh 20,000. Everybody clear with this part? Now let me go to the next one. So now they have told selling price stood at 15 rupees, variable cost stood at 10. So selling price 15 rupees means, can I say it is turning out to be 15 lakhs? And here it will be 18 lakhs. Variable cost 10 rupee means now it is 10 lakh. Last year it will be how much? 12 lakhs. Correct? Let's come down further. Fixed expense. Even before the fixed expense, can we put the contribution now? How much is going to be the contribution over here? 5 lakhs, 6 lakhs. Alright. So this is the contribution. From this contribution, we'll reduce the fixed cost now. What's the fixed cost? 2 lakhs. So once you reduce this, do you get your earnings before tax? How much is that? Is it turning out to be 3 lakhs over here and 4 lakhs over here? Okay. So once you get this, on this you will be having a tax rate. What is going to be the tax rate? 30%. 90,000, 1 lakh, 20,000. So now tell me, what will be your earnings after tax? Will it be 2 lakh 10,000 over here? And will it be 2 lakh 80,000 over here? Am I right? Okay. Once you get this number, they are asking you to find out the financial leverage, operating leverage, percentage change in the EPS. So wait, I just need to find out the EPS also. So let me put number of shares. I think it's given in the question. What's the number of shares? 20 lakh is the capital, 100 rupees is the face value. So I think there are 2 lakh shares are there. Correct? So in this case, can I find out what will be the EPS now? What is 2 lakh 10,000 divided by 2 lakhs? Do you get the answer as 1.05, and here do you get the answer as 1.40? Correct? Do you get the answer as 33.33%? Alright. Alright friends. From this, now I need to go and find out what is my degree of operating leverage, degree of financial leverage, degree of combined leverage. So what is the formula for operating leverage? Contribution divided by EBT. Correct. So 5 lakh divided by 3 lakh will give you 1.66 EBIT. EBIT, yeah, this is EBIT, sorry. This is earnings before interest and tax. Hold on. Sorry, I have forgotten the interest part. So sorry friends, I need to do a reworking here. I think I'll show you the answer, that's better. I'm not wasting my time writing it again. I made a small mistake. I forgot the interest part. So once you put the interest part also, see you got EBT, everything was correct. We did 18 lakhs, 12 lakhs, 6 lakhs, 2 lakhs is also okay. Interest of 2 lakh has been missed out. EBT, tax, PAT. So then you can find out the financial leverage, operating leverage. You get EPS also, and you get the changes in EPS also. So can you please write down this table in your books now friends on your own? I'll give you 5 minutes time. All right, friends. Are you all clear with this part now? Yes. So, friends, I think we are done with session 1. Shall we take a break now, friends? Please tell me, were you all comfortable with the session so far? If yes, please type a yes in the chat box, friends. I hope everything was comfortable. We finished dividend policy and leverages. After break, we will do ratio analysis and we will do the next coming chapter, I think, which is working capital management. Okay. All comfortable, right? Great. Fantastic, friends. So let's take a 30 minutes break now. Time is 10 o'clock. I'll get back at 10:30. Our next session will be from 10:30 to 12:30. All right. Then we'll have a lunch break and then the last session will be from 1:30 to 3 o'clock. Like that, we will do in 3 sessions today, friends. Okay. So after the break in the WhatsApp group, I'll again share the link. Okay. Thank you so much, friends. See you after the break.